Hi, my name is Britton Brown. I'm with TradeHive. I'm the founder, creator of TradeHiveCommunity.com, and I'm coming to you to make a video to help those aspiring traders out there that can't seem to keep their or pass a prop firm test, or those guys that can't keep their funded accounts. And here's the thing. Let me just come right out. This video is about teaching you institutional trading logic, okay? And I wanted to do some things on the internet to help those traders that want to get into this business and teach them the proper way to do this for a long time. I've been doing this for over 30 years, and I bought a lot of crappy indicators through the process. I've tried a lot of different systems over the years. The market it always evolves, and you may have an edge in one system for a while and it just doesn't work. And so I'm going to do this video, and then I'm going to follow it up with a second one for you that really just talks about optimal sizing, how I do it, how institutions do it. So if you're not familiar who I am, never seen these videos before, some of the things that I put out, every morning I give you a free overnight macro review of the market globally to help you set your day. Every weekend I do the Commitment of Traders report for you. I have a risk regime index that I put out, and basically it's to formulate what's the big money doing for you, right? Because you want to follow big money. And so as I do that for you, that's to help shape your bias for the week, for the next week or two, and then tell you what I'm looking for perhaps in the next COT report. If you are new to trading, you've never heard of the Commitment of Traders report, this is essential from an institutional side. And let me just give you a background. So I was one of the largest locals in the natural gas pit. I started my career at the Chicago Board of Trade. I had memberships at the Chicago Merc, at the Kansas City Board of Trade. I've been doing this, like I said, a long time. And so I ran an institutional desk. I know how this game works. I'm not going to tell you I make money every single day. That's just not realistic. But I control risk really, really well. And that is the name of the game for you. So if you're watching this, you're probably trying to figure out why some of your systems aren't working, why maybe perhaps you're not keeping a prop funded account. I've got a myriad of things I could say about prop accounts. I think it's a great way to get in the business. And if you're making money in them, great, but you need to start your own accounts so you can get away from the prop rules. I think they are designed to help them make money, not necessarily you. But I don't want to go down that road for you. Basically, let's stay on point here. I will start with the evolution of institutional trading logic, what TradeHive does, and why this will make the most sense for you. I spent a lot of years working on the system, and interestingly enough, there is a very famous trader by the name of Larry Williams, and he is a cycles trader and one of the best traders in the world. I think he's in his 80s now. And after years of working on this logic that I brought to the table, I found out that a lot of these things Larry Williams has been doing for years. And as a trader, it's a very lonely business, right? And so when I say that, a lot of times you hear about people, but you never really meet them. Maybe you read a few books here and there that basically helps take your trading to the next level. Some of it's great, some of it's crap, and you just throw it out. But that's what we do. This game changes so often that we're constantly evolving as a trader to try to get better and better. The nice thing about having over 30 years, Larry's been doing this for over 60 years. The things that I'm going to talk about today, you've got 90 years just in what I'm going to show you and how I approach the market, how Larry approach the market, what things have changed. I'm going to cover that for you. Footprint charts. I can't imagine trading without footprints. It's such a massive advantage to have a footprint, to have big trades, locators, indicators on your chart where you can see. I was talking to somebody the other day and they were struggling, and they were talking about they have level one quotes. And I was like, so what are you seeing on your charts? And they picked up their DOM and they showed me their DOM. And I was like, bro, you're not even seeing half of it. And you don't understand that, you might see, say on the micros, a 10 by 5 bid ask and 125 contracts just traded. You're not seeing that on what's going on the DOM. You're just seeing your bid ask. And so to be able to look inside of a candle and be able to put together a story of who's winning the game. And as I get started here, my philosophy is always, I'm a general, and this is a military operation. This is a battle that goes on throughout the day. The cool part is I can pick sides, right? And so what I want to do is figure out who's winning the battle and know where the big guns are, right? Those are your institutional players, what direction they're playing, and how to get on that right side. And so that's how I'm trying to read the market. When I see that buyers lose control and sellers step in, and maybe perhaps hedgers are coming into the market, structurally we're not sound and it looks like we're going to take a dip, then I'm going to switch sides. And as long as they're winning the battle, I'm going that direction. So my bias changes throughout the day from a short-term scalping aspect. And I'm not going to get in today totally how I trade. But I have swing trades that I do, big size trades that I want to put on for a big directional movement. There's certain things that I look for. But most of the time, like, today is February 25th. It's Wednesday, making this video for you. And we're basically in a late cycle. And this market is chopping around. It's been chopping around. If you watched a couple of my videos, if you've read any of my reports on the institutional framework that I put out for free for you to give you a really good foundation coming into the day, what those pivot points are going to be. Not necessarily, my pivot points are way different than, say, the guys out there that are posting pivot points all day long and they give you 20 of them, right? You don't need that. You need 3 basic trading plans coming into the day. And then, trading happens, and then but as long as you know where this market is trying to go, and where it fails in that process, and where then it's going to go from there, you can make those adjustments throughout the day. But I've always got a long-term bias in play. And so I'm going to show you some things that I think are going to completely change how you look at this, and perhaps I'm hoping going to make you a more profitable trader that's more consistent. And as I mentioned earlier, I cannot emphasize this more. Risk is your number one focus. It's not what your profit is. I look at risk first, profit target second, and then I'm going to adjust, monitor, and decide what kind of trade I'm taking. So with that said, I'm going to switch over. I'm going to leave the screen here. I'm going to throw you on a PowerPoint as I walk you through this. And I believe this is going to change dramatically how you approach the market and make a huge difference in what you're doing. So with that said, this is basically the evolution of trading logic from Larry Williams, who's been doing this for over 60 years, into what TradeHive has become. And the process here is to help you understand why this is sound information for you. All right. So hang on real quick. Let me just try to get this adjusted here. Let's talk about Larry Williams. Larry Williams is an amazing trader, and he talks about markets that move when big money positions themselves first, and then the volatility expands. There's different ways of looking at the market, but basically, depending on how you approach it, you should always be looking for a contraction. Perhaps I love a fake out one way, and then the expansion comes, and that's, you guys always talk about, oh, it's a liquidity grab. It's a liquidity grab. They're trying to stop us out. No, it is a liquidity grab. They're trying to fool you into believing the market's going to break one way, and that is the spring, right? Wyckoff talked about this. That is the spring that takes off in the real direction that it wants to go. So Larry Williams defines the framework. Wyckoff defines a framework for you. What we've done, or what I should say, what I've done at TradeHive is I've modernized it with precision execution tools. And that is, you have access to volume profiles. You need to be using those. Those tell such a huge story, whether you're looking at a long-term time frame or a short-term time frame. You should be using those. Just like on a footprint, you want to be able to see what delta is. You want to be able to see where the volume is actually taking place and where there's really no volume taking place at all on a candle. It's giving you kind of a look into really what's transpiring before that market actually does what it's supposed to do. So again, this is not a new idea. I've just refined it. And that is the evolution of institutional trading logic. And so everything that I come at you on a daily basis is to give you that institutional framework. And that's why my report's called the Institutional Framework. It's not something that you see on YouTube that is, how do I want to put this? It's not an all-in trade. Everything is methodical. Risk is first. And so anyway, we want to jump where big money moves first and the price flows. And so with that said, let's look at this. Larry Williams, like I said, kind of provided us an institutional blueprint, and that is the market bias is going to come first. We want to know, this is where we use the commitment of traders. That is going to tell us what the commercial positioning is. It's going to tell us what the institutional hedging behavior is. You need to know that, because little things like that are huge. If you know that the financial institutions themselves are long, and they're all pretty much always long, right? When you look at the hedging side of it and you see hedgers are extremely short and the market's going the other way, volatility expansion is going to be much higher, right? Because that is going to squeeze those hedges one way. What I don't like to see if I'm bullish is hedgers. I mean, it's a bonus, right? I just know we're going to grind when I see hedgers are reducing the downside risk, taking off some open interest. That means that the squeeze isn't going to be as much. So this is why the COT is so important. And it helps you establish your bias before you ever execute a trade. The other thing that Larry uses is time cycles, and they do matter. And I'm going to show you at some point here. God, I hope I remember to do this. I'm going to show you what a time cycle looks like, and it's not necessarily a predictor. It's not a signal indicator. It's just hey, where's big money going to react, and when are they going to defend? When are they going to push? So it's just an added edge to what we put together. The main thing about cycles is that markets repeat behavior and specific windows outperform randomness. And when I show you that chart, you're going to think, oh, this is BS. But the reality is it doesn't define how I enter a trade. It just tells me, is my trade in line with what's likely going to happen based off of historical prices. If you use an indicator, you are trading in the past. I really, other than a 9 EMA and a 32 EMA, and I really just use it for directional bias on longer term time frames. That is the only indicator outside of footprints, and volume profile that you're going to see on my chart. So understanding structure is critically important. He talks about expansion after compression. Markets coil, right? That's that compression. Then the volatility expands suddenly. And for him, profits obviously come from holding, not trading more. We live in a different world, and we'll talk a little bit about that, because what used to happen over a month period often happens in an afternoon. And that's the volatility part of our market that we trade now. And lastly, risk is non-negotiable. We have predefined stops, asymmetric payoffs, and one good move pays for many attempts, right? So those that like to trade, that's the hardest part about being a new trader is You want to trade all the time. I'm making this video as an example at 10:10, and the market took off this morning. We made a high. We're trying to hold above, right at the opening range breakout on the 15-minute. We are literally sitting there right now at 25,300, right above the anchored VWAP for the day. But the market's just chopping back and forth. So I thought, hey, you know what, this would be a great time to walk you through kind of what we do. So, oops, let me do this. I got ahead of myself here. My bad. So again, the execution sequence for Larry Williams, he uses a commitment to traders report. He uses a time window. He looks for compression, and then he goes with the expansion candle. And let's talk about what Larry didn't have. And obviously he has now. He's still trading, by the way. Occasionally you'll see him on YouTube, and he'll be talking about cycles and what he does. And love to see him out there. But hopefully he's writing a book right now, and I hope that that's going to come out here shortly. But what did he not have, right? We have the same market, new structure. What changed over the years? When Larry first started doing this, he was doing this on, drawing out candles. Now we have fully electronic markets, algorithmic execution, faster rotations, deeper liquidity, more compression, more violent expansions. But what stayed the same over the years is big money still drives direction. Liquidity still clusters. Expansion still follows positioning. So, the gap, Larry's philosophy remained correct. Obviously, still doing it at a high level. I believe he's 82. The execution tools back then lagged the market's evolution. The opportunity now is macro bias still works, but those moves that used to take weeks now take days or hours. But the entries must be intraday now. It's not more of a long-term buy and hold atmosphere. It will chop you to death. Case in point, there was a day last week. I think it was last week, or the week before, towards the end of the week, caught a 407-point move, had 500 points in it at one point, finally got stopped out. And that's not being braggadocious. It was the 4-hour 9 EMA crossed the 32, everything lined up. We've been knocking at the highs in the premium zone, and we got that move in like an hour and a half. It was done over. My trading day was, I think it was before 10 o'clock. It was an amazing day, but those days were not like that when Larry was trading. So the edge moves from knowing the idea to executing it better really is what it's all about, and that's what I'm here to talk to you about. So what is the philosophy? Again, it's same DNA, but just using modern tools. So my core principle is that I do not predict markets. I align with the capital that's already committed in the marketplace. So again, the bias is always set up with institutional mindset, the framework that they put together, capital positions before price moves from the institutional side. And if you've been doing this long enough, you know that when the market is really weak, institutions traditionally are buying. And when it's really strong, they are getting rid of all their trades, and you're taking on all that risk at the top, right? And so retail tends to react after the expansion. And the key is to trade with institutions, not against them. Understand how they enter a position, what are the things that you're looking for, and when that market's going to take off. Location is everything. It's gone are those days where, I remember back in the day, S&Ps for the day had a 3-handle range. A 5-handle range was a pretty normal day, and a 10-handle range was a great day for trading. And then all of a sudden now it's like we're swinging 50, 100 points. So the main thing is trades only occur at meaningful structures. That is a habit you need to get into. You don't chase the trades, and I'll talk to you a little bit more about that. Get out of the mid-range guessing. I know you love to trade, but it's just not going to be in your best interest. That is where everybody gets chopped up. That is where, when we get into a compression-like environment, that's where market makers are making the majority of their money. That is where institutions are trading contracts, and you're typically just going to get chopped up unless you're a really good range trader. So timing is compression based. Expansion is earned. Patience precedes profit, and stillness before violence. Remember, stillness before violence. So Larry defined what to trade. What I've done is I define when and where to execute. So let me get into this next part. So what is the big money context? That is the commitment of traders reports that we use. So what we want to do is, again, Larry Williams uses the commitment of traders reports. Commercials is the smart money. The speculative traders out there, that is the retail traders, is the fuel. And bias defines the macro aspect of the trade first. What I've tried to do, I say we a lot. What I've tried to do here, and what I have done over the years, is I've upgraded that. I blended the ES and NQ big money pressure. I put that out on the Commitment of Traders report that I do for you over the weekend. I do the Commitment of Traders report is accessible, totally broken down for you for ES and NQ individually. And then over the weekend, I do a video for you. And then throughout the week, I am putting the graphs in there so that you can see and come back to and remind yourself where the big money pressure is. Participation directional pressure is key. We want to know where the regime awareness aspect is. Basically, regime means risk on, risk off, and then continuous context, not static snapshots. So again, why this matters, Commitment of Traders tells you whose position, and then TradeHive, my system, basically the way I approach it, it's not really a system, it's just a market approach, tells how aggressively and in what regime you're in. So again, it's the same concept, just higher resolution. So let's talk about structure and location. So again, the core rule, if price is not at a level institutions care about, we do nothing. And the reason it works is institutions defend inventory. Institutions use VWAP to define the fair value of the day, and then the extremes force decisions, right? So Larry's view is support and resistance, prior highs and lows, which we still use, price zones with historical reactions, whereas my framework is the VWAP, anchored VWAP as an example. Let me talk about VWAP real quick, right? When I talk about VWAP, you can go back and you can look at the annual VWAP right now. We are under the annual VWAP. That's important because oftentimes, if you look at last year, anytime we got under the annual VWAP, we snap back in a hurry. Right now, we are trading for now weeks under VWAP. So that's important. The anchor VWAP is on a daily basis. That helps us guide our trades. And these are institutional anchors. I approach the market with a monthly, weekly, daily, and 4-hour structure. That is the same way institutions look at this market, and that's exactly why I do it. And then I look at a premium discount location as far as the model itself. And again, stay out of the trades in the middle. Now, I say stay out of the trades. Now, here's the reality. I'm a pretty good range trader. I understand rotation, and I love to scalp. But there are times where I am scalping. I'm trying to let runners go, but I'm scalping for maybe 10 handles or 20 handles. If I get a nice little breakout, I will try to manage that and let that run. Oftentimes when I'm doing that and I'm playing for a breakout, I'll have multiple contracts. And what I'll end up doing is taking some of those trades off at 10 handles, some of the trades off at 20 handles, and now I'm managing risk. I'm letting those initial trades pay for my trade to allow that thing to run. But at that point, everything is in profit. My stops are moved to profit. Again, today, the last couple of weeks has been very much try to let the runners go, take profits, use multiple contracts, not too aggressive. I'm reducing my risk when I'm scalping right now just because of the framework of the market. So again, what's the core rule? If price is not at a level institutions care about, you do nothing. And why it works is institutions defend the inventory. Again, VWAP defines fair value and extremes force decisions. Let's talk about timing and expansion, the cycles and sessions. When expansion is most likely to happen. Larry Williams' timing was all about seasonal tendencies, the cycle windows, and time-based repetition. Patience for the right window. In essence, wait till that market sets up perfectly, take the trade. He took a lot of heat. Interestingly enough, one of the best traders in the world, you hear about us talk about, oh, I don't want to risk more than 1% of my capital. Larry Williams was famous for 30% of his capital was at risk, almost the majority of all of his trades. But he won big. He lost a lot, but when he won big. So what I've done with the TradeHive timing model is using Asia, using London, using the New York session flows. That should be pretty familiar with you if you follow ICT as an example, right? We're all looking at this. This is nothing. ICT has done nothing original for the most part. There's a couple little things. He's basically taken Larry Williams stuff and he's taken other people's trades and ideas and just renamed it. So most of this stuff has been happening since the 60s. But anyway, I digress, and which I do a lot, and I apologize. I'm not here to beat up ICT. I think some of his stuff is super interesting. There's guys making a lot of money with it. I'm not so sure he makes any money with it, but he's certainly made things very complicated in an uncomplicated world. Liquidity builds, then releases. That's what we're looking for. Compression before expansion. We look at those kill zones, not random hours, where they're likely headed for targets. So the key insight I want you to take away today is time doesn't predict direction. It reveals opportunity. As I mentioned earlier, when you look at cycles is not an indicator. It's just basically an opportunity to see what the likely direction is for the opportunity that you're trading. Again, the reason it matters is most losses happen outside of expansion windows. Most profits come from short, violent moves, and timing filters bad trades before execution. All right, on to entry precision. Breakouts, re-engagement. Again, talking about Larry Williams' entry. Price breaks range, enter early in expansion, accept the heat for position. TradeHive's execution model is lower time frames, re-engagement, entry after a liquidity is taken. That's that spring effect on Wyckoff. That is one of my most favorite trades. And typically, I'm constantly, like I had mentioned before, I'm looking at the monthly, I'm looking at the daily, the weekly, the 4 hour. What are those longer term time frames telling me with my 9 and 32 EMAs? And then I'm looking for those markets to pull back in certain specific areas, look for the compression, look for the fake out, and then I'm looking for that movement to go with that trade. I'm always leery of an immediate breakout. It just really depends. You'll see boxes on my charts. That's the compression zone. If I'm mid-range and we break out in the direction, say on a lower time frame, say a 5 minute breaks out in the direction of the 1 hour and 4 hour, I will treat that like that's a viable breakout depending on how that candle looks inside. Again, that's footprint. That's the big trades. Is the big money coming after it? I'm, again, risk-based. I'm protecting that for a re-entry back into the zone and the market to go the opposite direction, because 9 out of 10 times those breakouts are fake. But when the market is set up structurally in the middle of a range that needs to run, and you can see that on the higher time frames because they've already contracted and now they're looking to go, those are good trade setups for you. So the core rule, we enter where others are forced to exit. That's that Wyckoff spring aspect of trading. And why is this an edge? Because we're entering on smaller time frames, because we're able to see the structure in the institutional framework, we're able to use footprint, use the volume profiles. It allows us to reduce our stop distance. It gives us a higher RR. And so earlier participation in the same expansion and the right expansion. is really the key. So let's talk about risk trade management. Risk and trade management is all about holding the expansion. So when we talk about Larry Williams' risk model, hard stops, predefined risk, meaning hard stop. When he sets a stop, the stop is set. He does not move that. He's got a predefined risk. He stays with that risk. You got fewer big winners that pay and a lot of small losses. For most traders, that is a recipe that psychologically they just cannot handle. So what I've done with my risk model is structure-based stops, size scaled by alignment, right? We'll get into that in a few minutes here. Partial profits only to fund the runner, right? And so what that means is as I mentioned earlier, if I've got a runner that I'm looking for the market to take off, I will take off partial profits to fund that trade. Nothing chaps me more than a market that goes in my direction. I don't move my stop into a break even. Somebody can come in at any point in time and absolutely change the entire framework of the day with one single trade. Now, nothing a retail trader can do, but an institutional trader can do that. And because of the volatility, I want to make sure that I at least capture. I can always re-enter a trade and still have the same basis fundamental aspect and the same framework if there's a sweep. If the way a sweep works, just so you know, is market makers stand out of the market and then the book is swept. And you can see that if you use heat maps is a perfect example. I can't imagine trading without it, to be honest with you. But anyway, scaled size by alignment, partial profits to fund the runner, and the core objective is stay in the move, right? And so there's little things that you can do that you cannot do unless you're using order flow, volume profile, footprints, and that is to find those low volume nodes. That's pretty much how I use risk management. You are blindly moving stops at areas of what looks like support and resistance. That is a retail perspective of risk management. I use low volume nodes and I look at it like this. As I mentioned before, this is a military action that's happening every day. There's a battle going on. And I look at low volume nodes as little encampments, right? So if the bulls are taking ground in the fight and they're winning, they will set up little areas. And that's how I kind of view a low volume node is it's a little encampment that they are pressing forward to take more new territory. And if the market goes down to that and it holds and takes back off, that is extremely bullish. But if it breaks that low volume node, now the sellers have taken some territory back. I hope this makes sense because for somebody, this is going to be a difference maker. They take that back and now we see a little bit of a change in the momentum from buyers to sellers. And so as I look for those low volume nodes, I can position my stop in areas just below those that I can allow the market to breathe and continue in the right direction. But if they take the encampment back, right, now they've taken ground back, and that is an indicator that I need to get out of the market at that point. So again, the core objective is stay in the move. The core rule, you do not trade to be right. You trade to stay in alignment with the market. And why does this matter? Overmanagement kills expansion trades, right? We all want to just take profits. You know, we get scared. Even guys that have been doing this for as long as I've known, right? You hate to see profit go. You know, it's different when you've got 400 points, 300 points into a move. You can weather a little bit of profit give back, right? Because that's part of trading, is you let those trades breathe and evolve. But when you're scalping, that's very difficult to do because this thing can whipsaw back and forth, and there's nothing worse than having 20 points in a trade, maybe on 5 lots, and then all of a sudden you're down 20 points and the whole thing shifted on you. So anyway, why it matters: overmanagement kills your expansion trades, capital survives volatility, and big money requires patience. And I can't stress that enough. So again, just to summarize what we're talking about from Larry Williams to TradeHive, same truth, sharper execution. And basically, TradeHive is Larry Williams' philosophy executed with modern institutional tools. So here's where we're going to transition a little bit. We've talked about structure, which is the where. We've talked about execution, which is the how. And I want to get into cycles because that's going to answer the when to take a trade. All right, so problem most traders are going to face is strong structure, weak timing. They take their profits too early, runners held too late, over trading late in moves. The solution that I provide you throughout this entire PowerPoint is cycles do not predict direction. Cycles regulate the behavior. Cycles are going to be what helps protect capital and help you expand your winners. So again, cycles define permission, not prediction. It is not an indicator. All right, it's just permission to trade in the direction that you want to trade. So again, cycles do not replace price. They do not override structure, and they do not remove risk. What they do is they help you improve your timing, improve your patience, improve your position management. A market cycle is simply a time-based probability window where pressure is more likely to expand, sustain, or exhaust itself. There are 3 cycle states you need to be aware of. Every market is always in one of these 3 states: an early cycle, a mid cycle, or a late cycle. There's no exceptions. There's no indicators required. You just need to understand that the market seems to do the same things over and over again. That's why you see so many people on the technical analysis side. What are you learning? In technical analysis, you're learning patterns, right? Whether it's a head and shoulders or it's a pattern where there's a volatility expansion with higher highs and higher lows. Those are all patterns, right? So in an early cycle expansion phase, you know the characteristics. You have a clean expansion after the balance. You've had a VWAP reclaimer acceptance. Your 9 EMA crosses maybe if you're bullish, it crosses to the upside over the 32. And expansion has occurred recently, not repeatedly. What you don't want to see is a constant expansion, volatility aspect of it. That's not a good sign for you. You may be making money from a scalping perspective, but that doesn't work out real well for swing traders out there. So my interpretation is energy is fresh, probability favors continuation, and you have your best risk reward window sitting in front of you. So let's talk about the characteristics. On a mid-cycle continuation phase, EMAs are fully aligned and separated. The trend is obvious and orderly. Pullbacks respect VWAP and 9 EMAs, and the distance from the VWAP increases gradually. My interpretation of that is the trend has been established, continuation is favored, and chasing is discouraged. This is not when you want to be chasing trades looking for a swing trade. In the late cycle exhaustion phase, we have the characteristics are multiple extensions away from VWAP. We may go down and touch it, go away from it, come back and touch it, go away from it. We may go through it and come back through, find the extension off the VWAP. We move higher, then we come back to VWAP. Momentum expands, price progresses, slows. Now this is really important. We see high volatility and lots of momentum in the trades, but there's a slowing progress in the direction that we're trying to go. You're going to see an increase in wicks and failed follow through. And basically, much like the momentum expands and price progress slows, volatility without meaningful advance is a key indicator that you're in an exhaustion phase. My interpretation of it is risk increases, expansion odds decrease, and capital protection takes priority. So When we talk about cycle bias, that's really just describing the energy, not necessarily the direction of the trade itself. So expansion, we have clean follow through, minimal overlap, smooth extensions. Neutral is that overlapping increases in price. VWAP acts as a magnet. Both sides are trading aggressively. Then we go into an exhaustion phase, which is volatility increases, progress stalls, failed extensions repeat, right? So this is an indicator for you. You're a new trader. You're a swing trader. You're trying to learn how to be a swing trader. And every time you put on a swing trade, you get a little bit of money into it, and then all of a sudden you're back at scratch, or worse, you've got a losing trade. This is a time to stand back. Take your loss, break even, get out of the market, let this market basically show you its hand in order to trade in the right direction. Sometimes it just has to go through the digestive portion of the trading cycle itself and then get back on the right train. Maybe we continue, maybe the market goes the opposite direction. So again, when you're in an early cycle, expansion entries are allowed, runners encouraged, ads are permitted with structure. In a mid-cycle, we are buying pullbacks only. We are partially scaling. And when I say that for the runner, that means that we are taking profits and letting that pay for the runner. We do not add late to the trade. There's no add-ons to this trade. In a late cycle, that is when I'm in scalp only mode. I'm reducing my size. I've got fixed targets, fixed risk analysis coming in with my trades, as always, and I'm not planning for runners. Now, every once in a while, I might let something go, but only because I've got multiple contracts on and I've already taken profit on the majority, and I'll let a one lot go in the market just to see if it will run. But again, risk management. I can allow that to happen and give back a break-even trade on something, or maybe a plus 10 handles because it gets up to 30, and maybe I move it up to 15, 20. I don't like it. I'll lock in the profit. If it keeps going, great. But most of the time I can tell you, just if you look at the probability factor of it, when you're in a late cycle trend, 30 is about the max. Sometimes you might get a 50 handle move, but they tend to crap out on you and come right back. And next thing you know, you've got a loser on your hands. So what are the hard risk rules? Non-negotiable. Early cycles, we do not scalp. We are looking for those runners. Mid-cycle, we do not chase. Okay, we're not adding on to. If we've missed it, we're not buying into it, right? Because you cannot take in a mid-cycle trade in the middle of an expansion move the heat that would cause you, in essence, what you'll find is you'll take 20 or 30 points of heat if you're not careful, or more, only to pray to Jesus that you're going to break even or maybe make a couple of ticks. And what I can also tell you, this will help you out. When you've taken a loss of say 10, 15, 20 ticks, oftentimes you bought at the wrong part of a consolidation pattern. Many times it will give you one, maybe two chances to break even. And what happens to new retail traders is that you get to break even, it shows you a little bit of green, maybe one or two ticks your favor, and then it goes away. And then it comes back. And now you think that this is the one, and it shows you green by one or two ticks, right? You could have gotten out at break even, and then the real move comes. It's a complete failure, and now you're down 50 points in a hurry. That's the way it works. In late cycle, again, it's scalp only. We do not hold runners. Cycle ignorance is expectancy decay. So again, Larry Williams to TradeHive Evolution. Traditional cycle use. Identify likely turning points, often traded as predictions. The advancement that I've tried to make with Larry Williams information, and really it was just, as I said in the beginning, I worked years on this and then finally started reading and listening to Larry Williams and thought, my God, I could have saved myself years of headaches trying to figure this out. And that is, again, it's the cool part is when you do that, it's kind of frustrating when you spend a lot of time doing that and then you find out somebody's actually already created that. But there's a learning process that has to take place, right? So for me, it cemented everything that I was working on, only to find out that somebody had been trading this at the highest level for many, many years more than I've been trading. And so that's the endorsement aspect of what I'm bringing you. I'm just adding another 30 years of help to you to give you a reason why you should be coming to my website and getting the free information I'm providing you. Because again, why is it free? Because I watched the videos of people in prop firms trading, and they are constantly, even the best guys that you watch that make $80,000, $100,000, they are blowing prop firms left and right. Their business model is to spend 300 grand but make $1 million going all in on every trade because it's what we call tradertainment. It is not teaching you how to be a professional trader on any level, right? And eventually these prop firms are going to stop allowing you to do this, having multiple accounts on your combines or your what do they call them? X something or other. Anyway, you're mid-level. You're not really trading, but you're trading, and they're paying you out like you're a professional trader, but you're really not. That stuff, there's a reason why these guys, every one of these prop firms seems to fail, and you start hearing about people not getting paid. It's not a winning business plan. So eventually, I think what this is going to do is it's going to come back for you and then make you actually trade one account. You're either profitable or you're not, or you're going to pay them a reset. And that's the way it is. And that's really what trading is. For me, if I lost my account, holy crap, right? I would lose my house. I'd lose my cars. I'd lose, everything that I have. And that is a tough place to be. I could tell you stories. There was times years back where I was on the wrong side of a market and I was extremely negative. And we're talking about 7 figures negative, waking up and being on the wrong side of the market with limit up in the natural gas. And I was extremely lucky that the broker that I had, the clearing firm, allowed me to stay in the market and work out of it. Otherwise, I'd have never paid that back. And, it was a great market, and I ended up having one of the best years that I had as a trader in the pits, but it was not without a lot of stress. But anyway, that's a different story. So again, the advancement is cycles do not call the tops or bottoms. Cycles just authorize or restrict our behavior. So the TradeHive rule is a trade is only permitted if structure agrees, regime agrees, and cycle state allows it. And that is really the formula I'm trying to provide you today, that if you want to be long-term in this marketplace, you've got to learn. Rewatch this video. I know it's probably a little long, but the reality is I'm giving you gold to be around for a very long time and be a profitable trader. So let's talk about the cycle and regime authorization. On the trend regime and early cycle, expansion trades, aggressive runners are allowed. Again, I'm just regurgitating what I said. Trend regime and mid-cycle, continuation only, controlled scaling. And any regime and late cycle, scalp only, capital preservation mode. If you do not have the tools that I mentioned before, that is volume profile, that is order flow, footprint charts, you really should not be scalping anything. That is a stand down market for you. Unfortunately for you, I will tell you that 80% of this market is spent in contraction, and then we get the expansion. So as a new trader, you want to trade, spend the money, get the right tools so that you can be successful. So why this fixes premature exits, right? Traditional trading pitfalls. Most traders exit early because they don't know where they are in the move, and they confuse momentum with sustainability. I'm going to say that again. You exit early because you don't know where you are in the move, and you confuse momentum with sustainability. What cycles and structures are going to do for you is it's going to give you the ability to have confidence in holding in early to mid moves. You're going to have better exit discipline late in the move, and you're going to get rid of the emotional interference that plagues everybody, no matter how long you've been trading. So again, the philosophy is structure tells us where, execution tells us how, and cycles tell us when. Timing intelligence is not optional at scale, it is required, right? And I know that everybody that comes into this thing wants to be a professional trader, would love to be a fund manager, work at an institutional bank, trade the big money, or maybe it's you want to trade for yourself and develop a big account so that you can consider yourself big money. Those prop firms are training you to over leverage. Do yourself a favor, trade the micros, trade one lots, build the account, then add a second lot. You have no business scaling into a trade or taking on size as a new trader. Your job as a new trader, and I'm going to throw this out real quick, and then I was going to show you, and sorry about this. I was going to show you what I meant by cycles. Let me see if I can pull this up real quick. All right, so this is the NASDAQ 100 chart, and this is the cycles of, when I talk about cycles, the ebb and flow of the marketplace. And as I said, markets tend to repeat themselves, right? So this is, you can go out and you can join a website out there that I think it starts maybe at $200 a year. Really what you want is $1,000 a year membership. But what this will provide you is the ability to go in and get into cycles and come up with your own cycle aspect of it. But this is going to show you, we can go out and identify the cycles of the market, the ebb and flow of the marketplace, and then we can overlay that with price. And so when you look at this, right, you can see that the market tends to make lows at certain times and highs at certain times, and then kind of rolls over. And it doesn't mean, when you see the downside and the upside, it doesn't mean it's supposed to go to the top. I know on the right-hand side of it, this year, we're at the top of the last quarter range of 2025. That is not an everyday occurrence, but the cycle is the cycle. And so what you can see is we bottom out at certain points of the year. And if you look at this, and I can just tell you, you can see the little pink on the bottom side, there's a circle right there. That is where we are today on the cycle. So this pullback that we've had, right, was something that we were anticipating as we were running into sellers at the top. I promise you, institutions look at this. You can pull these cycles up in any business, any industry. They look at it from a business perspective. As an example, if you know that there is cycles, I'll use the auto industry, right? There's sales cycles there for a specific amount of years. I can't remember, it's like 10 or 13 years. They have a boom that happens in auto sales. They're transitioning in the next year or two into a cycle that they start to, and we've already started to enter. You've heard about them talk about retail sales and autos are down. Pricing is coming down a little bit. It's not as aggressive. The lots are starting to fill up with cars. More deals will come out, right? And that's typically, if you're say Ford, you're not bringing new inventory or new concept cars to the marketplace when the cycle turns against you. You're using the cycle that turns against you for X amount of months or years sometimes to develop. That is your R&D aspect of putting new vehicles, new models out. You're developing those models so that as you get to the bottom part of that cycle and it starts to turn up, now the buyers are coming back into the marketplace and your cars are coming to the marketplace. And it's the same thing with the market. So yes, we've been weak. This is why commitment to traders is important for you, because you can see if the big financial institutions were liquidating their open interest at a feeding frenzy type of market, then that would be an indicator that there's more room in the cycle down. So what we're doing is combining the cycle with the COT commitment to traders reports. Again, it's not an indicator. It's just a, hey, is this idea that we could be heading up for the next couple of months more bullish, a real idea, giving me more conviction based on my setups? or are we still in a process of moving down with more sell-offs in the horizon? Well, right now the cycle is showing us that we should have, we're late, just so you know. I know it looks early right there, but we're kind of late in this movement aspect of it. But I can tell you that July is the topping point where we should start to see a couple of months of sell-off, where the institutions, if we can get back up into premium, they should be liquidating some of their positions as we get up there. So with this cycle, yes, I'm inclined to be bullish. I think that, perhaps maybe the selling pressure that we've been under is starting to go away. You're starting to see it even today. As of yesterday, if you watch my Commitment to Traders report, I was bullish coming into the week. I was looking for the framework to show itself, the institutions to show itself, because at that point last week, they really weren't defending, right? So anyway, I wanted to show you that so that you had a better idea of what we were looking at. Again, just to summarize for you, what's the credibility and lineage? This is totally proven ground, right? This framework endures. It's endured for over 60 years. 60 years of it traded with Larry Williams, 30 years of this traded by myself. That's a lot of years that I'm bringing you a viable way to develop trading systems around this. I want you to implement it, or at least think about it. Rewatch this thing, go back through it. Again, this is built on decades of futures market evidence. It's rooted in institutional behavior, not indicators. It survives regime changes, volatility cycles, and technology shifts. This framework stands on the shoulders of proven traders, refined, tested, and executed for today's market. So with that said, there's a compliance aspect and safe disclaimer here. I'm just going to throw that out. Let me get out of this. And I'm going to give you one last nugget. And that is, if you're working on a trading system for yourself, I know it can be really frustrating. You think you got something that works. You go back and back test. And again, back testing is not real trading. But the better you get the better you get better at back testing, the more the minutia of what you're doing is going to help you solidify whether you have a great trading system or not. And the tools are already out there. There's so many websites. I'm a Ninja Trader guy. I've been a Ninja Trader guy for a long time. There are other websites out there. Fabio and Andre honestly have one of the coolest trading platforms I've seen. I'm so close to making a switch myself, just because they've implemented a lot of things that I paid for over the years to have on Ninja Trader, and then some things I don't have. And that's not I'm not necessarily saying go and jump in there, but I kind of am in a way, because they give you the footprints, they give you the volume profiles, they give you the deltas. If you're not familiar with Fabio, he is by far one of the best scalper I've seen trade the markets. And I've been doing this a long time. I've been scalping for a long time. And Andre knows his shit, and they're bringing you a really good platform. I would suggest maybe starting there if you're not into footprints. At least watch their videos. You can learn a lot from them. But what I was going to tell you on going back and back testing, one of my favorite things to do is to throw out a crazy trading system. And it's more like a retail trading system. And then I look for the failure of it. And this is such a golden nugget for you. And the reason I love that, and the better the failure, the more excited I get, is because I can implement and reverse engineer that crappy trading system you think was pretty good for yourself. And so that's a really interesting way to take something that maybe you feel like you've wasted a lot of time doing and turning it to your advantage. And then find that when you reverse engineer it, You can take something that maybe was a 50 or 60% win rate, but you just churn. But what you want to do is look at where you're making money. Let's say you're making money and your MFE is small, but your MAE is high. In essence, when you make money, you make say $200 a trade, but when you lose money, you lose $1,800, $2,000, and it's flipping your system up. So you're just churning yourself, but you're not breaking even at the end of the year. Maybe it's the end of the month, whatever that is. I love to go reverse engineer those because it's telling you something that you weren't watching. And as a retail trader, you're a grinder, right? You're not used to being on the right side of the market for those big moves. You are what traditionally I've seen retail traders do is you make a little, you make a little, you make a little, and then boom, you've given back 6 winners in a row. You feel pretty good. You had a day where you had 7 or 8 trades and they were all winners. And you can't tell me you're not getting nervous. I know I am. If I've got a string, it's like I actually kind of thank you for the loss, right? And that's a tough place to be. But what I'm saying is get the loss on the books so I can go get my 6 or 7 more winners in a row. But that's controlling risk and knowing that I'm going to lose. And if I can control my risk, then I can weather the loss and then get right back into the game on the right side. And oftentimes a loss tells me a lot. It should tell you a lot. You're on the wrong side of the market. And if you're got enough volatility, you can get on the right side of the market and make a lot of money that day. But anyway, my point here is I hope you're going to take this away. That time that you work on back testing a program that isn't working and you notice that the drawdowns are really high, reverse it and go find why those drawdowns happen and see if you can't figure out how to be on the right side of those markets. You can learn a lot doing that. Thank you for watching this. I hope you've learned a lot. I will follow it up a little bit about sizing your trades and how to do that. It might be sometime next week when I do it. But I hope what you take away changes how you trade. You don't have to trade my system, right? The way my approach to the market. But just take something. If I gave you something that changed how you trade, that made you more profitable, then this video was 100% worth it. I hope it broke you out of the mode of looking at how these self-proclaimed gurus out there that are making the majority of their money with your monthly fee and put together a real professional way of looking at the markets, being here for a long time. I hope in 10 years from now, we're all still sitting here trading. I'm sure I will be. This is a lifelong endeavor. I started back in 1991, believe it or not, in the markets. And I don't see myself going anywhere. The market seems to only get better. From my perspective, the volatility is freaking awesome. But I hope you're here, and I hope you contact me 10 years from now and say, hey, thanks. I watched an old video that you put out on YouTube, and it made a difference and changed how I approached the market, and I became a profitable trader. And that's what it's all about. I would suggest go look up Andre and Fabio, watch some of their videos. They have fabulous videos. Those are probably 2 of the only guys I watch on YouTube, and I always take something away from it. They're telling you the truth. I love their attitudes. They walk the walk, they talk the talk, and I don't usually endorse somebody, but they're entertaining with real market information. So that's what I have to say today. Good luck. The market right now is still, it's coming off of we're still in that premium zone today. Market profile shows that we're still in the middle of it. The bias to the upside is there. This market could flip, of course, just like it could keep running. But it's got some work to do to get above the 350, 360 area. And this is really kind of, from my perspective, right now it is 11 o'clock Central Time. This is the market trying to formalize a position to go higher if it can sustain itself right here. Yesterday, I don't know if you're aware, but I was watching a lot of 400 and 500 lot executions on the sell side come into the market on the high side of discount, looking for a move back down, and they're trapped. So, can they withhold and sustain? Sure, because they're big money players. Were they just risking? I don't know. I would look at the zero DTE traders, the market makers out there, what they're doing right now. We've been negative gamma for a little bit for the last probably week or so. And so we could be rotational up here and move back down. But I like what I'm seeing right now. I've shown you the cycle. I would like to see this thing keep going. This is not one of those markets that I think we're going to run forever. But it's a good market. Is it a market that I'm transitioning to letting some runners go? No, we're still late in this thing, and it would have to prove itself. And I just don't think that it's viable to move out of the late expansion aspect of this market. I didn't like how long we stayed down in discount. That was not promising, but let the market prove itself. Let price action tell you where it's going, and let the institutions, if they come in, you start seeing them come in with size and reversing what those positions were from yesterday. That would get me excited. So appreciate your time. Good luck in trading. Appreciate it. Have an awesome day.